What's up? Today I'll be taking a look at Semiconductor ETFs SOXX, PSI, SMH, and XSD. First, we'll briefly cover what semiconductors are because we have to at least understand what we're investing in. We'll break down the portfolio composition of each ETF, the holdings, the costs, the performance, the ratings of each, and then I'll share my own opinion in which one I'm currently invested in, for whatever that's worth. If at any point you decide you like this video, feel free to hit the like button. That's what it's for. Without further rambling, let's get started. Semiconductors are materials that have an electrical conductivity between conductors, generally metals, and non-conductors or insulators, such as most ceramics. Semiconductors are used primarily in electronic devices, including chips, diodes, transistors, and integrated circuits. Anything that's computerized or uses radio waves depends on semiconductors. They have enabled advances in communications, computing, healthcare, military systems, transportation, clean energy, and countless other applications. Without them, there are no smartphones, radios, TVs, computers, video games, or advanced medical diagnostic equipment, and that will be a bummer. Now that we've got that science lesson out of the way, let's introduce the ETFs. SOXX is the iShares PHLX Semiconductor ETF by BlackRock. This ETF began trading in 2001, so it's the old man in the room. It has $6.5 billion in assets under management and tracks the PHLX Semiconductor Sector Index. PSI is the Invesco Dynamic Semiconductors ETF. It has been around since 2005 and has $606 million in assets under management and tracks the Dynamic Semiconductors Intellidex Index. SMH is the VanEck Vectors Semiconductors ETF. It's been around since 2011. It has $5.4 billion in assets under management and tracks the MVIS US Listed Semiconductors 25 Index. XSD is the SPDR S&P Semiconductor ETF by State Street Global Advisors. It has been around since 2006. It has $909 million in assets under management and tracks the S&P Semiconductor Select Industry Index. So let's take a look at portfolio composition. SMH is the most globally diverse on the list with 30% of its holdings outside the US. XSD, on the other hand, has 90% of its holdings within the US. As far as market capitalization goes, SOXX and SMH are both market cap weighted and are therefore mostly large cap. PSI uses a quantitative model to select and weight its holdings, so it is less concentrated in large caps, but still mostly large cap. XSD, however, is equal weighted, so we see a more even distribution of large, mid, and small caps. Equal weighted ETFs have an inherently buy high, sell low strategy, as they have to sell off the winners to buy more of the losers to maintain an equal weight. However, this can lead to more turnover and higher taxable events. Also, they tend to be more volatile because of the higher concentration of small caps. Let's move on to the holdings. I'll show the top 10 holdings, but I'll only summarize them as opposed to list them off because that would take forever. I would say SOXX is the most broadly diversified in terms of the different parts of the semiconductor market. The design, distribution, manufacture, and sale of semiconductors, it's all covered in this ETF. SOXX has 35 total holdings with well-known names such as NVIDIA, Texas Instruments, Broadcom, Qualcomm, and Intel topping the list. No company is over 10%. PSI really tries to pick out the winners as opposed to broadly diversifying. It evaluates companies based on a variety of criteria, including price momentum, earnings momentum, quality, management, action, and value. It features 31 companies and no holding is over 6%. AMD makes a showing in the top 10 of PSI. SMH is easily the most concentrated with only 26 companies, but note that Taiwan Semiconductors makes up 15% of SMH. There's certainly a concentration risk with this. It just depends on if you like the company or not. And again, the broader concentration risk of having so few holdings. XSD has the most holdings at 42. The current top holding, NVIDIA, only makes up 3.3%. So XSD is good if you want to be well spread out among different companies of different sizes. So let's take a look at cost, and first with that, expense ratios, the annual percentage that we have to pay for management. SOXX charges 0.46%, PSI charges 0.57%, both SMH and XSD are tied with both of them charging 0.35%. Now these issuers may seem like greedy savages compared to S&P 500 ETF issuers that only charge 0.03 or 0.04%. But again, these are more specialized ETFs that can potentially provide much higher returns. But don't get me wrong, cost is very important. Small differences in cost can add up to large sums over time. And it can be a real bummer in a bear market when your portfolio goes down or trades sideways and you're getting eaten alive by fees. But these ETFs have performed so well, sometimes we have to be careful to not step over dollars to pick up pennies. And while these ETFs may not be dirt cheap, they certainly are not considered expensive. And some would consider the cost difference between these ETFs to be negligible, and instead it's more important to focus on the different exposure strategies to determine which one is right for you. But continuing on cost, let's take a look at the tracking difference of each. Tracking difference shows how a product's performance compares with that of its benchmark over a stated period of time. It is a good report card for how well a manager is doing. It can depend on factors such as expense ratio, rebalancing cost, sampling, cash drag, security lending, and rebalancing timing. Given that fees are included, tracking difference is typically negative. The 12-month median tracking difference of SOXX is minus 0.77%, minus 0.97 for PSI, minus 0.5 for SMH, and minus 0.58 for XSD. So SMH wins in this category, with XSD as a close second. But let's take a look at spread costs. Spread is the measure of liquidity and the cost of trading shares. Essentially the difference between the lowest ask price and the highest bid price. The lower the spread is, the lower the cost is to trade. Typically the larger a fund is and the larger the trading volume, the lower the spread. The average spread for each is as follows: 0.02% for SOXX, 0.09% for PSI, 0.01% for SMH, and 0.08% for XSD. While SMH and SOXX take the win, these are all tight spreads, which is to be expected as these are all large and very liquid ETFs. This kind of liquidity is important for traders frequently moving large amounts of shares, but not as important for a buy and hold investor. Before we get into performance, let's quickly run through trailing 12-month dividend yields. Needless to say, we don't expect high dividends from high-growth semiconductor companies. Tech firms tend to reinvest their profits into future growth as opposed to paying out to their shareholders. We have a 0.7% dividend for SOXX, 0.15% for PSI, 0.6% for SMH, and 0.22% for XSD. So I suppose we give the win to SOXX with SMH a close second. But again, we don't really buy these for the dividend, we buy them for the growth. Speaking of growth, let's get into performance. Looking at one-year returns, PSI wins with a return of 81%. SOXX and SMH are close seconds, with XSD lagging behind at 66%, which is still a great yearly return, let's be honest. Looking at average 3-year returns, it is basically a three-way tie between SOXX, SMH, and XSD at 34%, with PSI only lagging by a few percent. Looking at 5-year average returns, SOXX has a slight win at 37%, PSI and SMH are hovering around 36%, and XSD down around 32%. In fact, if we sort all non-leverage ETFs by average 10-year returns, SOXX, PSI, and XSD are all the top 3 on the list, with an average return of 25, 24, and 22% respectively. SMH can't join this party because it's still too young. But this just gives us an idea of how strong semiconductors have been for the last decade. To put this into perspective, if you invested $1,000 a month for 40 years with an average return of 25%, after 40 years you would have $368 million. So obviously that would never happen, but a man can dream. And it does speak to the power of compound interest. But obviously past performance is no guarantee of future results. It just depends on how you see semis moving forward. If we take a look at the risk versus return graph, while all these ETFs have similar returns, PSI and XSD are further out on the risk axis, probably because of the higher concentration of small caps, particularly in XSD. While small caps are more likely to get hit harder in a market crisis, they have attractive upside in a bull market that can make it worth the risk for many investors. Lastly, let's look at Analyst Ratings. SOXX has an A from FactSet and 5 stars from Morningstar. PSI has a B from FactSet and 4 stars from Morningstar. SMH has an A from FactSet and 5 stars from Morningstar. XSD has an A from FactSet and 4 stars from Morningstar. So while these ETFs all have solid ratings, SOXX and SMH take the win in this category, with XSD a close second. So what are my thoughts? I personally own SMH. I don't mind the higher global exposure, and the concentration in Taiwan Semiconductors doesn't bother me. I think it's a good company. I also like the relatively large exposure to NVIDIA. All these ETFs have had incredible returns. Because I don't know which one will do better moving forward, I have a tendency to break ties by looking at metrics that I do have a better idea of moving forward, such as cost metrics like tracking difference, expense ratio, and spread costs. SMH either wins or does very well in all of these. But I also really like SOXX. I think it's well diversified within the industry. While I broke the tie with cost, I could certainly see myself owning both SOXX and SMH. But more important than which ETF to buy is whether or not to buy one at all. There is certainly a risk associated with owning a non-diversified sub-sector ETF as opposed to owning a broad market diversified index fund. This can lead to outperformance, but also potentially underperformance. Conventional wisdom says to dollar cost average into a low-cost diversified index fund and hold forever. But I think there is strong reason to believe in the growth of the semiconductor industry with ever-increasing demand for technology hardware. Growing trends in connectivity and mobility such as 5G mobile and self-driving cars can help drive semiconductor stocks. The same thing with increased demand for graphics processing units by gaming enthusiasts and cryptocurrency miners. Granted, sometimes the biggest risk is the unknown risk, in that we don't know what we don't know moving forward. For instance, there could be a potential risk with competing advanced future technologies. Also, there can be larger market factors outside of our control that could drive underperformance in these sectors. But I'm a believer that innovation is the driver of growth, and these semiconductor companies are currently fueling the growth of rapid technological innovation, and that's pretty exciting. But if you found this helpful, please consider hitting the like button and subscribe for more content like this. Also consider checking out the links down below. Currently down there you can get 2 free stocks with Webull, potentially valued up to $2,300, $30 with M1 Finance, a free stock with Robinhood, potentially valued up to $225, and up to $250 with BlockFi, where you can earn interest on your cryptocurrency. As always, none of this is to be considered financial advice. It's for entertainment purposes only. Thanks, and I'll see you in the next video.